fully set up and full vertical in Kazakhstan now. So spent time out there, met with regulators. Next month will be the national bank will issue essentially a letter saying that we can issue stable bonds from Kazakhstan. So
yeah,
really exciting stuff.
We should talk about this during the podcast. I think this is really interesting. Yeah, that you guys are targeting these not the most obvious locations, geography. Yeah, it's super cool.
Yeah, Central Asia, huge opportunity. Kind of like ignored part of the world from a crypto perspective.
Yeah.
Really interesting. I don't know if it's bad to just jump into this, but really interesting. It was really easy for us to talk to whoever we wanted. We met with the Ministry of Finance, we met with the National Bank, we met with anybody we asked to talk with. So from our perspective, it gives us access to the world there from Kazakhstan. So we went out there and got established. So next month we'll officially be issuing Kazakhstani debt on chain.
Nice.
Amazing. I mean, you mentioned that Kazakhstan was kind of cut out. I keep remembering all the mining farms that are set up in Kazakhstan. There was this from China to Kazakhstan because of energy, and it was a fun time.
Yeah, I believe it's cheapest energy in the world, especially for mining. One of the biggest, I met that guy. I can't remember his name, but biggest mining farm in the world was at dinner with us. And they're thinking about IPOing in the States, but yeah, they have absolute cheapest energy costs in the world. Yeah.
Was it EMCD maybe or BDC?
I don't remember. I'll have to go back and look. I met like 200 people in the space of like 72 hours. So I have notes that I took, but really interesting guy. And I'd never been to Kazakhstan personally. I'd never been in that part of the world. I'm really excited to be there. I mean, Istanbul is as far as I've been, as far as over there. But I think there's a lot of opportunity. I think it's totally forgotten and ignored part of the world from a Westerner's perspective. We see Russia and China, and then we don't think about anything else over there besides that, and then we realize, hey, there's a whole set of, but we're talking with a lot of the countries in Central Asia right now to continue to grow out there.
Awesome.
You guys know all of this. You guys are, way more savvy than we were, but pretty interesting.
Yeah.
That's what happens when you live in the western side of Europe. Eastern side of Europe. Yeah, you're not all caught up in the things that are maybe, I wouldn't call it like third world, second world, but yeah.
I never know. It was like I think that the term third world emerged when basically the US and Western countries were the first world, and USSR was kind of the second world. It was not a very widespread term, but the idea was it's like the second world, something like that. And then not belong to any.
I don't really know that third world makes too much sense anymore, because most of the cities, wherever we go are pretty modernized too. Maybe third world's defined by like countryside, but even in the US we got some pretty wild countryside, so so I don't know that it makes too much sense anymore.
It goes towards the economic state of the country. So if you're not top 10 GDP, you're not seeing the first world
got it
anytime soon.
So shall we start like the official part of the podcast, or like
let's do it. You guys are gonna have fun chopping this up, that's for sure.
I hit record like 4 minutes ago, just as soon as we got in, and I think it's that little bit of discussion was a good warm-up for what we're going to be discussing, of course. And we just want to start with the introductions. Dave, Etherfuse, I hope I'm pronouncing it right. Etherfuse?
Yep.
Yeah, that's it. So tell us more about Etherfuse, your kind of 1 minute elevator pitch. Now's the time to take it.
Sure. First, there's no right way to pronounce Etherfuse. That's how I say it. But when I go to Mexico, everyone says Etherfuse. So who am I to correct anybody? You know what I mean? Etherfuse, I think are forerunners in the space of thinking of non-Western countries in crypto, and that might be arrogant of me, but for a long time we thought, okay, the blockchain does a lot that changes the way that money can move, and that the future of finance will work. And a lot of people are imprinting the past onto the future of the blockchain. So a lot of the world sees how Swift works, and they think the blockchain will work that way. And what do I mean by that? Well, Swift is kind of like a dollar-denominated rails that you use to send value across to countries, and then you FX those value in different places. So if you want to use Swift, and I think a lot of people think the rise of Tether and the rise of Circle are going to be the same, where people send value across the world, like they send dollars across the world. We disagree, and we've disagreed for a long time. I think we were the second tokenized treasury in the world ever. We've just been working in non-obvious spaces. And so what we do is we build a new primitive to help see the world that we think should exist. And what does that mean? We create a reward-bearing sovereign product for each country. And what that is that is a yield-bearing stablecoin. And why do we think that's important? What we call a stable bond is, well, for DeFi to work efficiently and for money movement to efficiently move on chain, we need assets for each country to exist that can on and off ramp. Right now, you have this stablecoin sandwich, and people seem to be pretty happy with that, but it's highly inefficient. So what we try to do is we create an asset that people can work in every country. So as an example, if I'm in Mexico and I have a crypto card and I collateralize it with USDC, every time I make a payment, I have an FX hit. And so that doesn't seem to be an optimal way to work for a Mexican. So we create a Mexican denominated product. So you could use our product to collateralize it. Our Mexican product is called CETES. And what that is, it's just short-term treasuries. What does it look like on chain? It's just a peso denominated token that increases in value at the same rate as the sovereign debt that's collateralizing it. And we think this is important because for DeFi to work efficiently, you need marketplaces of both assets. However, the dollar and like other products are quite different. The dollar is a pretty good store of value around the world, but a lot of currencies are not a good store of value. So if you're expecting a tight spread in like an AMM, you're expecting people to LP an asset that's highly inflationary and not a great store of value. So we don't think that's going to work. So if you've read any of our papers, we say stablecoins are not enough. This is likely the most contrarian take we take, where everyone's all in on stablecoins, and we think good start, but it's not enough. Nobody wants to hold billions in US dollar value in Mexican peso or Brazilian real or the Kazakhstani tenge. They don't want to hold it because it's inflationary, and they'd rather store something in a store of value. So that means your AMM is going to have a lopsided marketplace. It means you're going to have a lot of demand for the non-US product, and you're going to have a lot of people willing to LP the US product. And so your spreads are not going to be tight. They're going to be worse than they are in DeFi. Well, what we've done is we've taken the country's sovereign debt and created a product so you can create a marketplace, and this product is a comparable store of value to the dollar. So people are willing to LP it. Why do I think it's a comparable store of value? Well, that's just how emerging market debt works. That's how debt works across the world. So every country, they issue sovereign debt. It's their main fundraising mechanism to invest in their own company. They want to sell their debt. So you have the smartest people of a country deciding what type of yields they should offer to people to borrow their debt. That yield is always given to incentivize you to not hold the dollar, but instead invest in their debt. So by default, our products are structured to be a comparable store value or better than the dollar. And if you look at our assets, our stable bond assets, almost all of them outperform the dollar and have for the last 20 years. And why is that? Because they have to. If a different country is going to incentivize you to hold their debt, it has to be a better store of value than the dollar. So we take that idea and we tokenize it. And we view this as the future of finance. We view these assets as being the assets that help FX to actually move on chain. A lot of people are thinking and talking, hey, let's move FX on chain. It's kind of a loser's game if you're not creating a reason to hold the asset that is not a great store of value or that is not the dollar. And you look out in the world, most trades are about 70% dollar, 30% non-US assets. On chain, it's like 99%. So we could assume that as things mature, that we'd have about the same, a regression to the mean, about 30% of non-US tokenized assets. But DeFi is more problematic in the sense that it's pretty expensive to LP. And so we think you need a different product. And this different product could actually help us exceed those numbers. We think it could be more close to half. So that's a long thing. So what is Etherfuse? Etherfuse is the idea behind that whole thesis, which is we issue a stable bond or a sovereign debt product from every country in the world, and we extend APIs to you that enable you to go from local banking in that country to that on-chain asset for free. And that's what Etherfuse does. And so we haven't completely seen our mission through yet, but we have about 8 products in production now, if you count this month that we're launching. And we have, by the end of this year, we'll have about 40. And so our goal is to get every country on chain through their sovereign debt product and those rails vertically integrated so people can build products on top of them.
Well, it's certainly a lot better than what I keep hearing about China and their CBDCs for the last God knows how many years.
Yeah.
It's quite a stretch there already.
Yeah, and I'm just curious. Well, yeah, thanks a lot for this intro. Like super helpful, like super interesting to know this. And I'm just curious, how much effort does it take you to do you work directly to the regulators, to like central bank, to like who is like emitting, or like how does the whole thing work? It's really interesting to know. Like probably it's very well known in TradFi world, but for crypto guys, we understand how like all these collaterals and stuff like that, like concentrated liquidity works. But something, like more regulated, it's very interesting to know more about.
Yeah, I mean, I wish there was an easy answer. There's a hard answer, is in every country is completely different. There's never been something that is exactly the same. And so what I mean by that is being able to issue a debt product is a different story. Being able to implement rails is a different story. So that is both the curse and blessing of Etherfuse. Is we've done a lot of hard work, and there's no like amount of money you could throw at it that you could quickly outscale us. You'd have to actually go and build, And so that's the good news, is like the work we've done is not easily just copy and pasteable. We kind of view entering a country through like four modes. One is we issue a stable bond product. 2, we use someone else for their rails. 3, we build our own rails. And 4, we go in and get regulated to issue. And those each require a different level of regulation. And we kind of look at the country and say, what's the least amount of work we can do to run our business? Mm-hmm. So the ideal scenario, we now issue out of 2 countries, Kazakhstan and Mexico. So the ideal scenario is when we go into a new country, we can go in as a foreign corporation. And we can find a broker there that will, like a regulated broker, that will let us create a foreign account. And from that foreign account, we can buy the collateral from that country and then issue an asset from a different country that is denominated in that currency. And so we have a partnership with Shinhan Bank in Korea, as an example. And so by the end of this year, we'll launch all of Asia. And we're doing that through Korea. So Shinhan has a presence all over Asia. We can buy debt through them and custody those in Korea. And then from Kazakhstan or Mexico or even Korea, maybe in the near future, we can issue those products. So there's not an easy answer for you there. But that's just the first part, is issuing the asset. The second part is how do we make it free to go from like a local bank account to an on-chain asset? that's a whole nother non-scalable workload, and it's usually a different set of requirements. So unfortunately, it's just different in every country.
Yeah, I can imagine. Yeah, that is very different. But it's like, yeah, I'm just trying to understand. So it's probably somewhat similar to how, let's say, USDC works, right? When they have, so basically they have to hold some like real dollars, like treasury bills, whatever they're using, and they use this as their off-chain collateral to issue USDCs. Does it work similarly? So you have certain amount of like the actual bonds of a certain country on your broker account in this country, and then you issue on chain. So does it work?
So yes, exactly. The one difference is, and we'll use USDC or USDT as an example. You give Circle $1, they give you the token, and they take 75% of that dollar and they buy bonds, and the other 25% they keep as fiat to manage volume. With us, you give me $1 and I put 100% of it in short-term treasuries of that currency. So if you give me 100 pesos, I buy 100 pesos worth of short-term Mexican treasuries. If you give me 100 reals, I buy. So we are fully collateralized, 100%. That has some implications, meaning like Circle, I think, is T0, meaning they hold float. We don't hold float. We hold our own float, but we don't hold customer float. So we can on and off ramp during market hours, but if you come on the weekend, you might have to wait. It's never happened, but it is like an edge case there. So we are 100% collateralized with short-term treasuries. So the best way to think about it is buying short-term treasuries directly.
Yeah. So, and I can really take my USDC, go to Etherfuse, and I will be able to get a tokenized version of whatever, like Mexican bonds, right?
Yep.
So, okay, and these bonds will be issued for me. So this is like not the secondary, or is it like the secondary market on chain, or will they be like issued online for me?
No. So in general, I mean, not always, but we buy through a primary broker through a secondary market. So we buy the shortest term, most liquid asset of the country. In general, that's going to be in a secondary market. If there's not a secondary market, you kind of have a liquidity problem, So we tend to find the most liquid assets. So this is talking about the collateral. We buy in general through a broker that is regulated there and a custodian. So like in Mexico, that's BBVA. In Brazil, it's B3. In Korea, it's Shinhan. In Kazakhstan, it's Halyk, if you know them. So these are all behemoths of banking corporations that we use, and we create an institutional account and we buy through them. And generally, we go through the secondary market.
Yeah. But so if I'm holding, sorry, I have so many questions. It's really very interesting. I think it's one of the most exciting parts of crypto today, because I see a lot of intersection between TradFi. So people are moving TradFi instruments on chain and vice versa, like trying to connect off-chain companies to some on-chain yield. So I think it's a very, very interesting part today. And I'm just curious. So let's say I'm holding some of your tokens. So what counterparty risk do I have? What if like something happens and Etherfuse just like goes out of business or whatever? Like what security checks do I have in place?
So legally, all our assets are what's called bankruptcy-remote, which is kind of what you're getting at. So if Etherfuse, the way that all of our assets are set up is they're segregated completely from operational elements. So we actually have two entities from each issuing asset. We have like our operational issuer, and then we have our customer funds. So these are completely segregated. Even flows are segregated. So if Etherfuse went out of business, legally, the token holder has a right or a claim to the underlying asset. So they're bankruptcy remote in that sense, where the ownership never sits on our balance sheet.
Mm-hmm.
And so in a bankruptcy situation, that would never be considered part of the bankruptcy process.
Mm-hmm.
And you can look at this if you go on our site, app.etherfuse.com/legal.
Mm-hmm.
We articulate, this is like the number one question everyone asks when they're
Yeah.
investing anything above $100, you know? So, yeah, the token owner is the legal owner of the corresponding collateral.
Yeah. Cool.
Interesting. I mean, that really set well the product foundation and the economics of how Etherfuse works. And I kind of want to know the regulatory path of Etherfuse, because there was Mexico as a blueprint. Now you're there, but you did receive this no action letter from the Mexican financial authority called CNBV.
That's right.
Yeah, in April of 2024. And there was also a submission of a letter to the SEC's crypto task force. Can't imagine how how bad things could have gone there. But yeah, a lot of founders talk about regulation in a broader term, and it's often most useful to hear what the process looked like in practice. And I kind of want to know more about that, because Mexico is especially interesting here, because you actually went through that work directly with the regulator and came out with something concrete. So how did you manage to, get that CNBV resolution, and what was the process there?
I mean, we started 5 years ago. It was like a 2-year process where you, in Mexico, they have this law called the FinTech law. And like since then, we've done this in a lot of places, not all to the same degree, and all have kind of operated differently. So the way we enter a country has been different in quite a bit of places. But there's this law called the FinTech law in Mexico, where it's like a sandbox. And the idea is that there's a technology that's sufficiently new that there's no legal way to have it be regulated. So you approach the regulators and say, hey, this is new and this is different. We think the CNBV is like the SEC of Mexico, so the regulator of securities. So we said, we think these are securities and that you should tell us how to regulate them so we can do it, And it was 2 years of responses back and forth. And so there was 3 kind of responses. And in each response, Mexico said, we don't view these as securities under Mexican law, which is weird. That's not what we expected in any way. We're essentially just tokenizing debt. But ironically, even the US has kind of made this kind of like new thing where synthetic, like you just heard the SEC kind of talk about synthetic. But anyways, so we said these are securities. 3 times they came back and said, no, they're not. And so the outcome of that is we have 300 pages of Mexico telling us what are under our protocol, what they are. And so it's company IP. We release like most of it, but not all of it, because it helps us run our business. But fundamentally, we understand the law and how to be regulated. We operate in Mexico not as a security, using this as like a defense mechanism. But we also had to go after that. No action letter is kind of interesting, but it's also kind of hard. Mm-hmm. When you get a no action letter, like the SEC doesn't think you're a security, but what do the tax people think? And then what does the Treasury think? And what does, the virtual asset? It just depends. So a no action letter is like the first step of a lot of work. And so like other places have been better, where they actually do give us like a concrete definition, because then you can say this is what it is. But in Mexico, all we have ever got is that this isn't regulated here. And so from that, we've built a regulatory strategy using responses to each request for interpretation on how things should be behaved. So just an example, they're not considered security, but the Bank of Mexico thinks differently. And then so we have to understand how they view about it. And then we have to understand how we pay taxes. Is this a security or is it not? Is it a virtual asset? So we did like almost 3 years of just back and forth with Mexico. It was the first country we entered, and it was complicated quite a bit. So, but yeah, so the story is it's just this long back and forth process.
I mean, it's great that you managed to come out on top there. I mean, government institutions can be very, blissfully ignorant towards anything that's on crypto rails, especially when we're talking about something close to a stable coin.
Yeah, I'm just so curious. Like, can you tell us a little more about Etherfuse as a company? It seems like you guys have to have like dozens of lawyers who like handling all these cases like in different countries. Can you tell us a little more really about the company?
Yeah, I mean, the company, the holding company is a US company. And so when we raise funds, we raise out of Etherfuse Inc. And then we also own subsidiaries. And so the operational elements are in different countries. We try to have the smallest footprint possible in each country to do our business, but that's different everywhere. So we have multiple subsidiaries across the world. And, luckily, what we've done will not be possible in 5 years, and it probably wouldn't be possible to start again. Because now I think if you went to Mexico and said, "Hey, look what I have," they'd say, "Oh, I'm familiar with this," or something like that. So the timing mattered, but for the most part, especially right now, a lot of countries are trying to figure out what their laws are, and so there's like informal avenues for you to approach them. But yes, we do eventually have to get lawyers, but we try to do as much as we can to get an idea of how to operate our business there without them. So just Kazakhstan as an example, Kazakhstan had kind of like an RF, request for comments, of like how you can do. So we actually approached them. Actually, they approached us and said, "Hey, this is how we would do our business." So it was an informal back and forth. And we got to a point where we're like, they're saying, "Hey, we want this here." And we say, "Okay," then we get a lawyer. So our goal is to do as much work as possible without a lawyer, just because actually lawyers make things quite complicated once you get to the point. And so our approach is to find the person in charge of innovation at the regulatory body and then have this discussion where you can kind of understand quite a bit up front. So yeah, unfortunately, there's no like playbook. Now we just go off of intuition. We're launching like a bunch of countries this next quarter or so. And a lot of it has just been like, "Hey, this worked here. How do you guys think about this?"
Yeah. And I'm curious. So you said that like Kazakhstan, for example, was very like excited to have you guys launch the product. How do you think it is useful for them as a country? Like, why do they need this product on chain?
Well, one, right now, 99% of stablecoins are dollar denominated. So you lose a huge part of your sovereignty if your population uses a foreign currency. So that's one. So that's coming. And you'll start to see reflexive behavior coming up. Like MICA is a tariff on dollar denominated stablecoins, So they're doing that to prevent the growth of a foreign currency. So a lot of these smaller countries are saying, "Dude, we need to do something," Now, additional to that, the most, like, every company wants to make money. Every country wants to make money. And so the way countries make money or earn revenue is through a sell of their debt. So our product reinforces the sell, it gives them a new channel, and it gets them exposure to foreign investors in a more meaningful and optimal way than anything else in the world. So a country looks at us and they say, "Hey, this is the internet. Like you were selling newspapers, here comes the internet." And you go, "Wow, I can sell a lot more newspapers on the internet." And so if you think about, extrapolate the blockchain's growth, I think it'll be the primary avenue of sell of a country's debt here pretty soon. And so we give you that optionality. And right now, nobody's really doing this but us.
Yeah, cool. Have you seen any countries that are like less excited about this opportunity, or? So like the big ones, it's not less excited. It's just harder. Like we haven't really gone to Europe yet, or like it's just be a nightmare. China, of course. I'm sure Russia would love it, but we can't. But most are kind of like optimistic about it. But the smaller countries are the ones that are hungry. So like Central Asia,
open door policy with us. Like we just kind of walk in and we meet with people and they're excited and we say, okay, how do we do it? And it like moves super quick, right? Because you have these like countries of population size 10, 20 million. Okay, Brazil, also excited, but it's a huge country. And so they have more negative, I'd say, externalities from any choice they're going to make. And so it's a little slower.
Yeah, I see. Interesting. And is there any limit on like how much someone can purchase, let's say, like Mexican debt, whatever debt, through Etherfuse, or I can grab 1 million and billion, whatever?
So the crypto economy is miniature compared to the TradFi economy, and so
this is true.
We don't require on-chain liquidity because we bridge straight to the banking infrastructure. So like I think the daily Mexican CETES volume is something like 50 billion. It's like some crazy number, right?
Yeah.
So you could come to me and ask for $100 million of bonds, and I could fulfill it within market hours, easy. So no, there's no limit. Now, from an AML standpoint, we have volume limits. We don't cap you, but at certain levels, we require different levels of KYB and KYC. And in some cases, we need you to upfront tell us like what your volumes will be and provide supporting evidence for that. And so if you all came to me with 100x of the volumes that I was aware of, I would need information from you of like where that money's coming from. So no limit, but there are caveats to everything.
Yeah. So you guys, actually, so something I also wanted to ask about. So does everyone has to be KYC'd? So if I want to purchase any of Etherfuse issued tokens, I have to be KYC'd, right?
If so, we almost operate exactly like a Tether or Circle, where we have like an Etherfuse mint product.
Okay.
And we don't charge any fees, right? So if you want to mint and burn directly from us, we give you guaranteed pricing. Now, our assets are freely transferable. So though that we require KYB, KYC, absolutely. But our assets are freely transferable, so they end up in secondary markets. So most people probably just open up their wallet and search Etherfuse and then pull it from an AMM somewhere, So most people don't because they are available in DeFi.
Yeah, interesting. So if I only need to be KYC if I want to interact with the protocol directly, right? Not from the secondary market. Yeah, cool. Yeah, very interesting concept. Yeah, and speaking of blockchains, I think your main blockchain is Stellar, where like most activity happens.
Yeah. Solana and Stellar, right?
Yeah, by far we have the most activity on Stellar. Solana would be a close second, but we're available on Monad, Solana, Stellar, Base, Polygon, and we should be launching 1 or 2 more here pretty soon.
I kind of wanted to touch on the technical implementation here because Etherfuse issues, as you mentioned, both on Solana and Stellar, mainly Stellar. And CTs are natively issued on Solana with daily NAV updates and instant settlements. And there's, of course, this 100 currencies vision because you aim to bring 107 currencies on chain as yield-bearing assets, kind of the AWS as sovereign debt. And I kind of want to know how you would manage to do that and what the kind of thinking here is and what's your roadmap to achieve it.
Well, there's like different levels of utility. The first usefulness is if you can mint and burn direct, you can issue an asset into your wallet right away. So getting to 100 is totally achievable. We're on track, I would say. We're launching all of Asia with a partner like next quarter. And so that gives us like 30, so we're working on it. Maybe we won't get to 100 this year, but we're trying, But the idea is that kind of scales where we set up these institutional accounts, we issue them. What doesn't scale is for DeFi to work smoothly, you need liquidity for each of these assets. That'll just take time, to be honest. DeFi is very thirsty, and so we'll have to prove utility for those. We think we'll get the utility. Like I can send money from Brazil straight to Mexico without any US dollar product in between, so it's cheaper. And I'll be able to do that through my assets, right? And so each new asset type we brings a new opportunities and flows that don't exist today. And so we think we'll get liquidity from people who want to LP their own flows and create tighter spreads for their own trades. When you LP, you earn money because it's a yield-bearing product. And then if you can lower your trade for the flows you have, the fees you have, that's like a win-win. So a lot of work to do for sure.
Yeah. And this brings me to the institutional adoption of things. Oh, Max, did you want to?
Yeah, I'm just want to get back to blockchain's question really quick. I'm just curious how you guys have Ether in your name, but you are not really active on Ethereum. So I'm just really curious why you decided to go with these chains and not to go to Ethereum.
Stellar Fuse.
Well, yeah. The name aside, really the chains we primarily thought of would be quick with low transactional fees. And with sovereign debt, if you add 10 bips, it's like it could kill you, meaning you have to hold it for 7 more days. So that's how we thought about things. Now, the Etherfuse is just coincidentally shares the same 4 characters or 5 characters of Ethereum. Etherfuse, the idea is you have like these things floating in the ether and we're connecting them together. So unfortunate that they're so close and everyone has that as a mnemonic, but that's the story.
Yeah.
I actually have a follow-up question here because we kind of want to touch on the economics here a little bit, because one of the strongest parts of the Etherfuse story is the fact that it takes a problem people already understand, like cross-border friction, and puts like a hard number on it. And if traditional rails can eat up to like 7% and you're bringing that down to 4 basis points, people will want to understand exactly where those costs used to sit and how you managed to like strip them out. So could you walk us through the math of how you managed to remove those layers of fees?
I mean, I think the biggest, first is you remove a lot of middlemen, which stablecoins do in general. So that brought us from 7% to 1%. But outside of that, now you've taken, so FX today requires pre-funding accounts. Mm-hmm. So if you're a company and you're going to invest in a company that provides a service to pre-fund accounts to enable FX or put it in bonds, you need to make sure that the revenue from pre-funding accounts is greater than bond yield. Does that make sense?
Yeah, I mean, that's the math right there.
So the math is now if I took away the need to pre-fund accounts and I incorporate bond yield, the ceiling of what the person returns is lower than the fees they would be otherwise charged. Mm-hmm. Does that make sense?
Yeah, I mean,
and so now
removing the friction.
Yeah, exactly. And also, while I'm pre-funding DeFi accounts, which just means providing and LPing, I'm also earning yield. So my spreads are tighter because it's a competitive market, a commodity now. And so I'm earning yield. So I will make my trade demands are going to be as small as possible for me to earn money. Mm-hmm. So that is the kind of like, I would say, non-mathematical thesis behind it.
Yeah. I mean, thank you for making it non-mathematical. I mean, things kind of, smoothly come together in that complex 3-step, path that you laid to, of course, remove those layer costs. But touching up, going back to, institutional adoption, there is, of course, this big difference between a product being technically available and institutions being ready to size it in a kind of serious way. And for that kind of next step, the question becomes what standards or infrastructure or like trust signals, because we had a space and we discussed a lot of trust signals for the institutionals there that need to be in place. And I guess my question would be, what needs to happen for institutional capital to flow meaningfully into these instruments like FX and the yield-bearing situation?
I think right now just time, but I think so. I would reframe this in the sense that TradFi works really good for the top 1%. Meaning, if you're a corporation and you're sending $400 million across borders and you need it T1, stablecoins won't compete with that.
Yeah,
they don't. They just add friction because the way TradFi works is, the more more business you have, you can command a cheaper rate because the people facilitating that trade will earn more even though they're sending more, right? Stablecoins really works at scale for the bottom 75%, if that makes sense. So if you want to send 100K, 200K, $1 million, and you have predictable flows, or if you want to do like an app that has payouts to 100,000 people, like it's just better. It's less friction, it's programmable, and you can't really do that with TradFi. Now, so when you say, how are we going to win institutional flows? When I think of institutional flows, I think of the first use case, which is Mitsubishi sending money from, Japan, or maybe not Mitsubishi, but China to Mexico, right? They'll send it once, I think institutions need to kind of rethink about how they send money across. It can be cheap or near free if they break it up. Mm-hmm. Also, I think they need to think of it as more like, right now TradFi is like earn money for a month, send it over. It's like more discrete, where money movement in the future should be more fluid, meaning like every day I'm sending money to the different place. So it's a hard question, but the biggest thing is, how can institutionals build trust? It's already happening. They're already integrating. They're already seeing the value. I think stablecoins is a perfect use case for about 75% of money movement, and it enables like the people who were severely hindered, the bottom quartile, to send money for about the same price as TradFi. So yeah, I don't know if that makes sense. Kind of a rant, but
yeah, I mean, wait till investment bankers hear about this, and the fact that there's money to be made. They'll definitely be all over there. And I actually had follow-up about the real world use case. You managed to put that perfectly in there. Maybe Max, you have anything to add there?
I wanted to. So I just I checked. Like, I think it's not TVL. What's the right word to describe like RWA, like total assets distributed or something like that? I think it's somewhere around 20 mil for you guys these days, right?
Our TVL should probably be around 40. If you talk RWA, where we're missing some stuff, but our monthly volume is more like 17 to 20 million.
Okay. Oh, okay. So I checked some random website, RWA XYZ, probably drilling a certain part of the assets. Right. And I'm curious, like, so what's your business model here? And I'm not sure if this figure is public, how much money your guys making. And
well, maybe the second one I won't answer, but our business model is mostly because we don't want to invite unnecessary competition, but we act like a broker. So we have a broker fee that is on our website. It's basically anywhere from 15 bips to like 150 bips, depending on your asset type and the riskiness involved. But it's cheaper than what a broker would charge you directly. So it's still saving quite a bit of value there. Then we also provide an FX API. So we manage the FX and liquidity between two of our assets. So we have a small fee there as well. We also use our own assets for our own strategies. So lending markets and things like that. So we make quite a bit of revenue just by creating liquidity for lending markets in these different currencies. So those are the three main ways that we make money. But we're post Series A. So we have post Series A's revenue. We'll probably raise a Series B in the next 8 months. So we have close to Series B revenues. Yeah.
So how much did you guys raise in total? So you had seed first and you closed around A2, right?
Yeah, we had pre-seed, seed. We closed a year ago around about $5 million.
Cool. Great.
So
yeah.
I was thinking of asking a question about privacy and transparency, because privacy is one of those topics that gets really broad in agreement in theory, then becomes much more nuanced once regulated finance products kind of enter the picture. And with sovereign instruments on chain, it's useful to, I think, maybe separate these parts of the stack where confidentiality adds value in the parts where transparency and reporting are essential. And of course, there's this like neutral overlap with Arcane, which builds privacy and compliance infrastructure, and Etherfuse deals with regulated sovereign assets. And the question here would be, of course, for like tokenized government bonds, where does privacy matter? Where does it not? And et cetera.
don't know. Privacy isn't our job, we provide the asset. I'm sure there are investors who would love privacy and maybe that'd help us sell some more. I think it will matter, So I think we view more as ourselves as like synergistic with you guys. Does that make sense? Like we have a big job to do, so we'll focus on that job. And then if there's a privacy protocol that, can abstract transactions and things like that, I'm sure we'll incorporate those pretty soon. Yeah, I mean, from the regulator standpoint, everything's available to them. We report vulnerable transactions. We report a lot of different things. But I can see from the general public standpoint, there's going to be a lot of demand for institutions to not necessarily give all their competitors all the information of who their customers are and things like that. So I don't know that we've reached that scale yet, but it's definitely coming.
Yeah, I can see. So I don't know, maybe it's like an imagined case, but let's say some company wants to mint certain amount of certain tokens that you guys issue, and they don't want this information to be public. So like they want to mint private. So of course this wouldn't be private from you. Like you have to disclose everything. They, as a regulated company, have to disclose everything. But like some random external observers, competitors, whoever, won't be able to see that. I think that this is at least like our vision how things should work. So like our approach to privacy is not to hide from from government, from regulators, and so on, but just So it's basically like TradFi privacy, right? So things are by default private in TradFi. So you're doing like wiring transfer, no one sees that. So it's basically the idea is to recreate that, and I hope there will be some synergy, and so at least I should be able to buy this privately in the secondary market at least. So if
I think you can buy it anonymously today. I don't think you can buy it privately yet, and so it's definitely gonna need to exist.
Yeah, by anonymously you mean so you are just, as they call it, like pseudonymously. So just people don't know that this wallet belongs to you, and that's why they cannot.
On secondary markets, yes.
That brings me to a question of compliance and practice, because I mean, anytime you're dealing with regulated assets and real capital flows, which it usually does, compliance is like the most important part of the product experience. And I'm sure people listening afterwards will want to know how onboarding, verification, and these ongoing controls actually work in a way that supports access without creating this unnecessary friction, which was a big topic today. So the question would be, how do you handle KYC AML for stable bond purchasers? Simple as that.
I mean, unfortunately, ours is quite complicated. We had to build our own system, but mostly because when you're issuing something that could be considered a security, there's a lot of like existing templates for it. So like SumSub and Plaid get only part away there. So we use some of those tools, but like in Mexico, when we issue out of Mexico, there's the INE. It's like an identity government agency. You have to check against those. Mm-hmm. So we built our own KYC and KYB infrastructure. Oh. So, and that was because there's nothing else existed. This is a new technology, and there's an overlap between a lot of different like houses of law, and so we had to build our own.
Did it take you long to adapt it to this new product?
For sure, it takes as much time to build this as it does everything else. It's quite annoying.
I mean, R&D doing God's work.
It's really annoying. I wish there was some company that wanted to do it and we could just depend on them, but they have to specifically do stuff for us. So we had to build it ourselves.
Literally take our money and just do it for us.
Yeah, just do it. I'll give you what we have. Go run it. Go start a business. You know, we don't.
Yeah, whatever.
Yeah, we don't want to do it.
Sorry.
No, we don't want to do it, but we have to. Yeah.
whenever the question comes around, privacy and you know the guy. He's right here with us.
Yeah. No, we'll definitely be reaching out in the near future. That's for sure.
Yeah.
So far we've talked about product structure, the economics, the regulatory work, and the use cases, which gives a pretty clear and full picture of what you guys are building. To kind of close it off, I'd love to kind of zoom out and ask what success looks like if this model really reaches a scale of 1 billion. Right now you're over around 40 million from what I heard, and if it goes to 1 billion and if Etherfuse succeeds over the next few years, what changes about how people and businesses access sovereign currencies and government debt for you?
I think if Etherfuse is successful, we'll exist, but you won't necessarily know who we are. I think we're like an infrastructure layer for other companies to build meaningful products that let them do business in the new financial world. So I think what it means is we're no longer building KYB infrastructure. We're just issuing assets. And we can focus on ensuring there's proper liquidity and properly vertically integrated infrastructure for our APIs for every country in the world. So that's what I think success is for us, is to kind of like be the platform that people build on and not necessarily the distribution channel.
Mm-hmm. That makes a lot of sense. Thank you for explaining that in a way and putting it into an analogy, because again, whatever is hidden, whatever works, I think the good example here would be the RPC node providers. I mean, crypto rails are on all of these nodes and everything works, and builders on Solana are gaining a lot of success, and maybe Solana doesn't get the recognition it deserves, and I think perhaps there is a lot of merit to what you guys do, and I'd love to see what it evolves into the future. I'm definitely going to be checking out your products, that's for sure, because you got money laying around. Why would I just have it there if there's something like this that I could use?
Exactly.
Max? Yeah. Anything you want to add, Max?
Oh, no, not really. Not really. Yeah. Thanks a lot, Dave. Great conversation. Thanks a lot for sharing a lot of insights about the company and everything. Yeah. Very exciting space. Yeah.
Appreciate this opportunity, guys.
Yeah.
Yeah.
I think this podcast episode is going to, remove a bit of a friction for people that are going to be coming in and booking demos with you. I think perhaps a lot of the things that you explained are going to be clear for first base, and I hope the people that really need this will find this, and we're going to be able to work this out somehow in the future.
I will try and buy some of the tokens you guys are issuing. So
let's do it. Yeah. Great.
It's interesting.
Not financial advice, by the way. That's a disclaimer that we gotta put here.
Yeah.
All right, guys. Thank you for your time. Appreciate it, and we'll see you around.